our human resource management subject. Today we are looking at performance-related pay, which is a subtopic in the reward management area of human resource management. And performance-related pay, as is used in human resource management, performance-related pay scheme is a remuneration system where reward to an employee depends on the performance of an employee, and the performance of the organization. So you can see, dear learner, there are two things. Performance-related pay is dependent on how the employee performs and how the organization performs. And that's why the issue of relationship comes in. So performance-related pay. So the pay is at two performance levels. The employee is expected to perform at a particular level, and the organization itself is also supposed to have performed at a particular level for this to be effective. Now, there are four main features of performance-related pay, and these four main features are the basis of the scheme, consolidated pay increases, variable pay, and pay progression. So when it comes to the basis of the scheme, in relation to performance-related pay, the basis of the scheme must be defined, and the basis of the scheme may, for example, be maybe organizational performance, So the way the organization performs may be the basis of the scheme, so that you look at the overall organization performance, and then the performance-related pay could be determined. Maybe you may want to look at it in terms of maybe a bonus, and the bonuses could be, for example, of various types. So the basis of the scheme may be organizational performance, which may be affected now in terms of the bonus or bonuses to be paid. Then when it comes to the consolidated pay increases, maybe the pay may be increased, pay may be adjusted, pay may be adjusted based on particular parameters that they may, for example, come in, and it will be in a consolidated way, so that a particular specified amount may be the total amount that is given as an increase, as a pay increase, and that may be given maybe at one point in time or over a period of time. And then when it comes to variable pay, the way the word suggests, this may vary and may be paid one-off payment. So let us say in the month of the end of December of a given year, an employee or a group of employees have performed and are supposed to be provided with a variable pay. Then for that particular end of year, maybe December or January, those particular employees, their pay is varied and then readjusted. Or maybe it is varied at one time, and then it's a one-off adjustment, and that becomes the variable pay, which is a feature of performance-related pay. Then there could also be pay progression determined. This could be determined for a given period. So you may, for example, say there will be pay progression maybe at the end of 1 year, say maybe in the month of July or in the month of January, the pay progression will take place, and it will be progressing maybe at a particular percentage, maybe at say 5% of the prevailing, for example, scale and so on. So that again could become pay progression as a feature of performance-related pay. So these are some of the main features of performance-related pay that we have indicated. Looks at specifically the performance of the individual and the performance of the organization. So what could be some of the suitable conditions for performance-related pay? Suitable conditions for performance related pay. Suitable conditions for performance related pay. And by this, dear learner, what we mean, what features should prevail on the ground, or what circumstances should prevail in an organization to make it suitable for an organization to operate a performance related pay system. So one, an organization should have an entrepreneurial culture. An organization should have an entrepreneurial culture. So where employees are entrepreneurial, then these employees can invest their ideas, can invest their innovation, and that one can lead to better performance of the workers and the organization. So there should be a practice of employee involvement in decision making. So for you to have a successful performance related pay system, then workers in that particular organization should have gone through a practice of being involved in the decision-making process, so that they can participate fully in ensuring that they can be able to bring in the aspect of performance-related pay in terms of agreeing on objectives. And then number 3, transparency in salary and wage, or what you are calling reward management matters. There should be transparency in salary and wage or reward management matters, so that workers can be able to have confidence in this particular system. Then 4, clear objectives of performance. A clear objective of performance must be in that particular environment, so that it is very clear in terms of what is expected, in terms of the management and so on, in terms of the workers. So that could be very, very clear. Then number 5, supervisors and managers should be well versed and skilled in managing performance. And then there should be a clear communication channel in the organization. And then number 7, full support of the top management regarding performance related pay. So what you are saying, Lana, there should be full support of the top management regarding performance related pay. Is it? And then number 8, payments should be made when they are due to gain the confidence of employees in the system. So learner, workers will give the system a benefit of the doubt, and they will want to see one cycle. So if they agree on what is supposed to be paid, they produce on their part and so on, the organization gains, so the workers will be waiting to see, will the management make that particular commitment in terms of payment? So if those payments are made, then workers can support the system. So these are some of the factors that should be suitable conditions for performance-related pay to succeed within a given organization. So today, learner, we have looked at the performance-related pay area of reward management, and we have listed some of the suitable conditions. We have also looked at the main features, and we can very quickly revise what we have done today. And we have said that performance-related pay scheme is a remuneration system where reward to an employee depends on the performance of an employee and the performance of an organization. And the main features of performance-related pay are 1, the basis of the scheme, then 2, consolidated pay increases, then 3, variable pay, then 4, pay progression. And we have also indicated and discussed that when it comes to performance-related pay, for it to be able to succeed, dear learner, there are certain conditions that should be suitable, or an environment that will be suitable for the success of performance-related pay system. And we are saying that number 1, an organization should have an entrepreneurial culture. Then 2, there should be a practice of employee involvement in decision making. Then number 3, there should be transparency in salary and wage or reward management matters. Number 4, clear objectives of performance should be set out. Number 5, supervisors and managers should be well versed and skilled in managing performance. Number 6, there should be a clear communication channel in the organization. Number 7, full support of the top management regarding performance-related pay. And number 8, payments should be made when they are due to gain the confidence of employees in the system of performance-related pay. So, dear learner, those are some of the suitable conditions under which performance-related pay system can be able to be operated objectively and successfully. So before we terminate our lesson today, you have an assignment. Your assignment for today, examine the conditions, that may make the performance related pay system succeed in a workplace. So dear learner, your assignment, examine the conditions that may make the performance related pay system succeed in a workplace. So that's your assignment, and until our next lesson, bye-bye.
Hello student, my name is Isaac Juguna, and welcome to Manifest Publishers, and also welcome to this class today. And we are learning, today we are going to cover core application of data analytics. The subject we are going to cover today is a core application of data analytics under the subject known as application in financial management, application in financial management. And the unit or other subtopic that you're going to cover is loan amortization. We're going to cover a subtopic called loan amortization. And in that case, what is the aim? By the end of this lesson, you as student, you're going to be able to prepare a loan amortization schedule. You're able to prepare a loan amortization schedule, and we do it using Microsoft Excel. We're going to do it using Microsoft Excel. And to start with, first you can see we are on our computer, we are on desktop. We are going to know how to create a folder where we are going to then open the Excel, then save. Creating a folder, we just right click, new folder. Let's say our folder, we call it data analytics. Then enter. Then after that, now we open Excel. Just start button, just click start button, then you open Excel, Microsoft Excel, or rather still you can just come and write there Excel. Once you open Excel, it is very important you click blank workbook. So we start by saving it. We save it in our folder. So file, save as. It is we created our folder on the desktop. So we click here desktop. We choose our folder. Another state we can create it here. Call it it is data analytics. Let's write it in capital. Data analytics. Then enter. Just double click. Then let's we give a file name. In this case, let's call it loan amortization. We call it loan amortization. Then press enter to save it. So now we have opened our Excel, and we have saved. So now in this case, in a very simple terms, let me here as I am in Excel so that you are able to see it very well. Let's increase the font a little bit. So let's ask ourselves, what is loan amortization? What is loan amortization? What is loan amortization? So in this case, we can define it in just simple words. Basically, we say loan amortization, it is the process. It is the process of reducing. It is the process of reducing or paying off debt with regular payments. So we are saying that loan amortization, in this case, let me increase the size. So we are saying it is the process of reducing or paying off debt with regular payment. That is loan amortization. And in this case, to assist us to know how to do the loan amortization, we are going to have to do a simple question that is going to help so that we understand how to prepare the loan amortization schedule. Once again, let me increase the size a little bit. So let me, the question is that an investor borrowed a 6-year loan amounting 1.8 million, 1.8 million at annual rate of 12%, at annual rate of 12%. So we are required, let me increase the size still again a little bit. So required, or rather the question now we have been asked, required, we prepare, the required now, the question is prepare a loan amortization schedule. Prepare a loan amortization, prepare a loan amortization schedule. Prepare a loan amortization schedule. So let me repeat the question. So you're saying an investor borrowed a 6-year loan amounting to 1.8 million, and annual rate, at annual rate, borrowed, and that is at annual rate, that is at annual rate of 12%. So you are required, to prepare a loan amortization schedule. So that is our question. So now, using this Excel, how do we go about preparing this loan amortization schedule? So let me highlight where I want to work and increase just size a little bit so that it is very visible. So now, from our question, we have various things. We have the rate. We are given the rate, which is 12%. We are given the amount, and we are given the period, which is now 6 year. It is 6 years. So what we do, we just prepare a small table here. We come and write interest that way. Then the other one we write, we have the number of years. We are given the number of years, which is a 6 year. So we can write number of years, Then the other thing we are given is the amount borrowed. We are given the amount borrowed. We are given the amount borrowed. So you just write it there. So that's what you have as per question. That's what we have. So now, for us to be able to prepare a loan amortization, so you are going to use a formula which you call present value annuity factor. That is, we are going to use present value annuity factor. So here we write that way. Can write in capital present value annuity, present value interest annuity factor. Then after that, we need to know the installment. What shall we be paying on a regular basis? So we write installment there. Just write in small letters. We write installment like that. Then after that, so in this case we have the interest, and interest from our question is 12%. So we write 12% there. Number of years, it is 6 year loan. So we write 6. Amount borrowed, the amount borrowed in this case is 1.8, or rather 1,800,000. Write our figure there, 1,800,000. Then from there, that's what we have. So here we can form a table here, we call it year. Then after that, the years we have, it is 1, 2, 3, 4, 5, 6. Then after that we have the balance. You have the balance brought down. Then from there we have another column here, we call it interest. After that you're going to have the installments, and then let's just make it, or rather resize it a little bit. Then after that we have now the balance. Here we write balance carried down. So that is our table. So in this case, so that it is can be able to see it very well, let's just highlight. We put the borders. So borders is just home. Here we have where icon called borders. You click there, choose all borders. Just choose all borders. So meaning that now you can be able to view it very well, or rather let me make it much better. So let me click up there, alignment, then border. I choose a thick color a little bit, then I click outline and inside, so that now you can see this is the price of our interest, or rather we have now the table where we are going to work to do our calculations. So now in this case, very important, we have the interest, we have the number of years, and we have the amount borrowed. So how are we going to know the installment that you're going to pay every year? And in that case, or rather, what shall we be paying on a regular basis every year? So in this case, we say that we are going to use the present value interest annuity factor, and we have a formula for that. So we can just write that formula just here. Let's just write this is let me write in capital. Present value interest annuity factor. So the formula I'm going to use is this. We say that it is equals into bracket 1 minus into bracket 1 plus r, which is the rate, as r, which is the rate, then all that cross the bracket, least power n, least power negative n, all that cross the bracket, all that divided by r. So that is the formula we are going to use. So the formula for present value interests annuity factor is equals, that is 1 minus into bracket 1 plus r least power n, all that divided by r. So you're going to apply it here on our table, that is a present value interest annuity factor. So we write equals, you open the bracket, that is 1 minus into bracket, that is 1 plus r. What is our r? Is 12%. So you just click that 12%. Then you close the bracket, raised power negative n. N is number of period. So we click n, which is our number of period. Then after that, you close the bracket. All that, what you have written, we divide by, so you write divide by r. So you click 12% again. Then after that, you just enter. Then after that, you just enter. So if you click, this is now, you have seen our result is 4.11,140,7324. So if you click here, you check there at the formula bar, you can see we have written it is equals 1, that is equals into bracket 1 minus into bracket 1 plus r. R, which is 12%. In that case, it is dedicating I10 according to which column is and which row is. It is I10. You close the bracket, least power negative n, which is indicating that it is I11. This one 6 I11, all that divided by the rate once again. So having done that, how now do you calculate the installment? To calculate the installment, you say that it is equals the amount borrowed, which is 1,800,000, divided by present value interests annuity factor. Then you enter. So now you can see the installment that you'll be paying on regular basis is 437,806.2932. That is the installment that you'll be paying on regular basis, or rather in the, our question, on yearly basis. On yearly basis, I repeat that to find the installment, you just write equals the amount borrowed divided by the present value interest annuity factor. So enter. Then after that, now we have our table here. The balance brought down. The balance brought down in this case, it is equals the amount we borrowed, which is 1.8 million. Then what will be the interest? The interest of that amount, it will be equals. We have our rate is 12% times the amount borrowed. Then enter. So I repeat, I've said that it is equals the interest rate multiplied by the amount borrowed, which is 1.8. Enter. So having done that, it is good that you click that figure. You can see where we have the I10, which stands for the interest. Since this interest rate of 12% is constant, so we lock it. We lock so that it can be constant. So to lock it is the shift and 4 in between the label I, shift and 4. That is $sign. You put $sign to lock it. Then after that, how do you find the installment? The installment is equals. It's just here, installment. Let me repeat. You click the installment, the cell for installment, you write equals, click the figure here, which is 437,806, enter. So this installment, still it is constant. Every year you are required to pay 437,806. So still it's good that you lock it. Shift R in between the label. Enter. Then after that, what will be now the balance carried down? The balance carried down, we say that it is equals what you borrowed, 1.8, plus the interest minus what have been paid the first year, which is 437,806. Enter. So the balance carried by the end of the year, the balance carried down, it will be 1,578,193.707. So what will be the balance brought down for the second year? It will be equals. You click the balance carried down for the first year. Enter. So what will now be the interest for that amount for the second year? So it is equals the interest times our figure now balance brought down for the second year. Enter. So we say that we lock the interest part. So we click here, $sign, and this other one, $sign. Enter. Then what about the installment? So the installment remain the same. which is this one, 4.7.806. So we click it. So still it's very important that also we lock it. Also we lock it, and again here we lock it. Enter. Then what will be the balance carried down for the second year? Once again, it is equals the balance brought down for the second year plus the interest of the second year minus the installment. So up to that point, you can see the balance brought down is reducing, and you can see also the interest amount. This is now the interest amount is also reducing. But what remains constant is the installment, what you are paying on yearly basis. Those regular payment, just from our definition, is what is remaining constant, or rather the amount is not changing. So we do the same and the same again for the other year. Let's still do for the third year. So for the third year, it will be equals. You click the balance brought down for the second year now. Enter. What will be the interest? The interest will be equals our 12%. We click it, multiplied by the balance brought down for the third year. Enter. Again, it's very important that we lock shift 4, that is $sign, in between the label I. Enter. Then installment, you click 4.7.806. That one remain constant. Also remember to lock it. Also remember to lock it. Shift 4 in between the label. What will be the balance carried down for the third year? It will be equals the balance brought down plus the interest amount minus the installment. So having done that, you might be having, assuming now here you have 6 years, you just do like that. But now it will be somehow tiresome if you do it manually for all those years. Let's say you could be having like 20 years. So doing one, it might seem to be very tiresome. So in this case, it's good that you have to do for the first year and for the second year. For the first year and for the second year, you do it manually, just like the way we have done it. You just do it manually like that. So to make it easier, so now I have deleted for the third year. So I come and highlight this second year, the whole of it. Then here you can see the plus. It's called the out of field hurdle. You hold that out of field hurdle, then you drag it down. You drag it down. So after that, you can see our figures here, the way it looks like. So highlight the whole of it, so that we format to numbers. So you can just click number, then number, you click OK. You click OK. You can see now we borrowed 1,800,000, and by the end of 6 years, we are able to complete the payment. We have now the zero amount here, meaning that we have finished, or rather we have completed our loan, which was 1.8 million. Very important to note is this formula is key. This formula is the one which is enabling us to do everything. That is the present value interest annuity factor. That is the key, which is equals into bracket 1 minus into bracket 1 plus r into bracket raised power negative n, all that divided by r. And now in that case, we are able, we have managed to solve our problem. We have managed to solve our we have managed to do the loan amortization as for our question. So in that case, I'm going to give you a question so that now, applying the knowledge that you have learned here, you try to practice it. I'm just going to type it here at the end. So let me write, this is a assignment. An assignment we're going to give you is that an investor borrowed a 9-year loan amounting 3,600,000 at an annual rate of 13%. So an investor borrowed a 9-year loan amounting 3.6 million at an annual rate of 13%. So let me lap. Okay, at an annual rate of 13%. So in that case, what will be now the question? So you are required prepare a monthly loan amortization schedule. So the assignment I'm giving you is that an investor borrowed a 9-year loan amounting 3.6 million at annual rate of 13%. The question, or rather required, prepare a monthly loan amortization schedule. So kindly, applying the knowledge that you have learned today, so kindly try to do that assignment. Thank you very much. I hope we have been able to achieve the objective of this lesson. God bless you.
Hi candidates, welcome to another session of Manifested Online Classes. In this session, I want us to look on an illustration question regarding how to prepare the group accounts, whereby we have a disposal of interest. And the illustration I want us to go through reads, Pareto Limited is a holding company of a listed group of companies with its year ended on 30th of June 2021. So Pareto Limited has made a number of acquisition and a disposal of investment. So the following summarized draft statement of financial position relate to the group companies for the year which ended 30th of June 2021. So we are given the statement of financial position for 3 companies, Pareto, Paba, and also Dafu Limited. Non-current assets include property, plant, and equipment. Then we have investment in Paba, investment in Dafu. We have financial assets, and then we have the current assets. We have the total assets. At the equity, we have ordinary share capital, share premium, retained earnings, and then we have non-current liabilities and current liabilities. Then we have some additional information. Number 1, where we are told on 1st of October 2020, Pareto Limited acquired an 80% equity interest in Paba Limited when it retained earnings stood at 3,500 million. The purchase consideration comprised of 1,250 million of Pareto Limited shares with a nominal value of shillings 1 each and a market price of 6.8 each. At the acquisition of Paba Limited, the only adjustment required for to the identifiable net asset of Paba was for land which had a carrying amount of 625 million, less than its fair value. So number 2, we are told the group policy is to measure non-controlling interest at fair value. That information definitely is to guide you how to compute the goodwill. If you come across that information that the group policy is to measure NCI at fair value, it means that when computing the goodwill, we then compute that goodwill using the full goodwill method. And then you're told at the date of acquisition of Paba Limited, the non-controlling interest had a fair value of 21.25 million. Number 3, Pareto Limited had acquired 100% equity interest in Darfur a number of years ago when it retained earnings amounted to 1750 million. At acquisition, the fair value of identifiable net asset of Darfur approximated their carrying values. The purchase consideration comprised cash amounting to shillings 5750 million. Number 4, you're told Pareto Limited disposed of 60% of its investment in Darfur on 1st of April 2021 for shillings 4,700 million, when the fair value of identifiable net asset of Darfur were shillings 6250 million. The fair value of the remaining 40% equity interest was 4,300 million at disposal. Pareto Limited has not accounted for the disposal. And then number 5, you're told none of the companies had issued any shares since Pareto Limited acquired its shareholding in them. And number 6, you are told neither the goodwill on acquisition of subsidiaries nor investment in associate, that is, had been impaired. So from that information, what you're required to do, number 1, is we compute the goodwill arising on acquisition of the investment in the subsidiaries. Number 2, to compute the gain or loss arising on disposal of the investment in Darfur as reported, Roman 1, the individual financial statement of Pareto, Roman 2, consolidated statement of profit or loss, and finally part C of that question we are required to prepare the consolidated statement of financial position as at 30th of June 2021. So these are questions for group account, and as usual what we need to do first of all is to come up with a group structure. Then we go through the additional information, we see whether there are workings which we need to do, and then from there we prepare, or basically we compute what is required. So therefore, let's first of all we come up with the group structure here, which will be working 1, group structure, group structure. So where do we get that particular information about the group structure? So that information we have it from the additional information number 1, whereby we are told on 1st of October 2020, Pareto Limited acquired 80% equity interest in the company which is called Paba Limited on 1st of October 2020. 1st of October 2020, and also we are given the retained earnings of Paba on that date. That one will be used in the computation of goodwill, including the purchase consideration. That one will be used in the computation of goodwill. But let first of all we go to the additional information number 3, whereby we are told Paba Limited, not Paba but rather Pareto Limited had acquired 100% equity interest, 100% equity interest in the company which is called Darfur Limited a number of years ago. So in this case, we are not given the specific date of acquisition, but we are told Pareto Limited had acquired 100% shareholding in Darfur sometime back, or basically a number of years ago. So basically what that means is that from this group structure here, Pareto Limited, this will be the parent company, and automatically the parent company is the one which is supposed to prepare the group account. Then PABA is a subsidiary, and also Dafu here is a fully owned subsidiary, a fully owned. Fully owned means that the parent company acquired all the shares or hold all the shares in that particular subsidiary. So we have that information, but also before we go maybe back to note number 1, there is another information which is given and which is very, very important in note number 4, sorry, where we are told Pareto Limited disposed of 60% of its investment in Dafu on 1st of April 2021. So that is the information about disposal of interest. Disposal of interest. Disposal of interest, whereby we are told Pareto Limited disposed 60% shareholding in what? In Dafu. So we have disposal of interest in Dafu Limited. Dafu Limited. So, and automatically this particular disposal of interest, this usually take place during the current financial year. Now, first of all, if we go to the information we have at the paragraph 3 up there, so the current financial year was all ended on 31st of or that is June 2021. So basically what that means is that this year started on 1st of July 2020. But now if we go back to the information we have in note number 4, we are told Pareto Limited disposed 60% of its investment in Dafu during the current year. So that is the 1st of April 2021. 1st of April 2021. So how many months do we have here to the date of consolidation? We have April, May, June. So here we have 3 months, and automatically here we have what? 9 months. So what that means is that for the first 6 months, this particular company here, that is Dafu, this was a subsidiary, because you can see in the first 9 months, the parent company had 100% shareholding. But on this date, we are told the parent company disposed 60% of its shareholding in Dafu. So that what that means is that the parent company retained 40% shareholding in Dafu, and therefore Dafu in the last 3 months was an associate. And therefore, if for example in this particular question here the examiner was requiring the candidate to prepare the consolidated income statement, it's very, very important to note that this company here, that is Dafu, for the first 9 months you treat it as a subsidiary, meaning that you take into account its revenue and expenses for the first 9 months, for the first 9 months, and then you add that to the revenue and expenses of the parent and the revenue and expenses of what? Of PABA. But in the last 3 months, that is, Dafu Limited will be an associate, and therefore what you need to include in the consolidated income statement is the parent company share of Dafu Limited profit after tax in the last 3 months. And also in this case, because the parent company lost the control, you have to determine the gain or loss on disposal, which then you recognize in the income statement as part of the profit or loss. But in our case, if you check on what the examiner was requiring here, specifically in part C, we are only required to prepare the consolidated statement of profit, the consolidated statement of financial position. So what that means is that in preparing that, we check the status, we determine the status of Dafu at the end of the year. Dafu Limited at the end of the year will be an associate, and therefore in preparing the consolidated statement of financial position, we are going to add similar items of asset and liabilities, those of Pareto, the parent, and those of PABA, but we are not going to take into account the asset and liabilities of Dafu because it's an associate. So what we are going to do is we are going to determine something called the investment in associate, and basically that is the only item we are going to include in the consolidated statement of financial position as far as Dafu Limited is concerned. Yes, that is why the group structure here is important. But before you do that, maybe you can just go through this additional information again, we see whether there are some workings which are required. Note number 1, we go back to note number 1. We are given information about the acquisition of PABA, and actually the retained earnings, the purchase consideration, that all that will be used in the computation of goodwill, which you are required to compute as per part 1 of that question. And also we are told that at the date of acquisition, PABA Limited, or at the acquisition of PABA, the only adjustment required to the identifiable net asset of PABA was a LAD with a carrying value of 625 million less than the fair value. So basically what that means is that this company on the date of acquisition revalued the asset, and remember that process we refer to it as the fair value adjustment or the fair value exercise. So this is by PABA Limited, and the asset it revalued was LAD, and we are told that this LAD had a carrying amount of its carrying amount was 625 million less than the fair value. So in this case, the carrying amount was less than the fair value with an amount of 625 million. In other terms, we can say that the fair value, we start with the fair value, was greater or was more than the carrying amount with 625. So automatically, what is this? This is a revaluation gain. And this particular revaluation gain, which occurred on the date of acquisition, automatically was not accounted for by PABA. So therefore, in preparing the consolidated statement of financial position, this one we added to the group PP, and number 2, this one we treat it as a pre-acquisition revaluation reserve, pre-acquisition revaluation reserve. In computing the goodwill on acquisition, that will be one of the component of the net worth asset of PABA Limited. So I think we have that particular information there. And then it is also important to note that this particular asset here, that is LAD, this is not a depreciable asset. LAD is not depreciated, and therefore in this case, no depreciation other charge. No depreciation other charge to be computed here, simply because LAD is not depreciable asset. But if this was a depreciable asset, we needed to compute the depreciation other charge. So let's move to, but we will still come back to that particular point, specifically in answering part A of that question when computing the goodwill. So in number 2 is about information regarding the computation of goodwill. We will still use that in answering part A. And then part additional information number 3, we are given information about the acquisition of Pareto, where we are told the parent company, that is the acquisition of Dafu, whereby we are told Pareto Limited had acquired 100% shareholding in Dafu some time back. We are given it retained earnings there, and also the fair value of identifiable assets, which we are told equal to the carrying amount. So mean that at the date of acquisition, this company revalued the asset, and the fair value of identifiable asset was equal to carrying amount. There was no revaluation gain or loss. And then you're given the purchase consideration, which was 5750. All that information we are going to use it in answering part A, specifically in computing the goodwill. And then we're given information number 4 about the disposal of some disposal of interest in Dafu, and also this one we are going to use it in answering part B of that particular question. And then we have note 5. Note 6. I think no working which is required here, so I think we can go straight to part A of that particular question. Part A of the question. So what you are required to do is to compute the goodwill arising on acquisition of investment in subsidiaries. Investment in subsidiaries. So we start by computing the goodwill arising on acquisition of the first subsidiary here, that is PABA So let's start by computing the goodwill arising on acquisition of investment in Paba Limited. Paba Limited. Equally, remember, as per the information which are given in note number 2, we are computing the goodwill using the full goodwill method. That's the first thing you need to appreciate, or basically to note. So how do we compute the goodwill using the full goodwill method? Number 1, we take the cost of investment. The cost of investment. So how much purchase consideration was paid by the parent company in acquiring the shares of Paba? So that information, we have it in the balance sheet or in the statement of financial position of Pareto, specifically at the non-current asset. We are given the amount of the amount invested by Pareto in Paba, which is 8,500. 8,500. So to this, then we add the NCI at fair value because you're using the full goodwill method. So this figure is also given in note number 2. Additional information number 2, the last sentence we are told, at the date of acquisition of Paba, the non-controlling interest had a fair value of 21.25. So we add the 2. So this will give us 25, 10, 6, 10, 6. So let's confirm whether that is correct. So we have 85 plus 21.25, so which will give us 10,625. That is correct. So then from there we proceed and we less fair value of net assets, fair value of net assets acquired. So how do we compute this one? Because it's not given, so we have to determine the fair value of a net asset of Paba on the date it was acquired, and we determine that by taking the ordinary share capital of Paba plus pre-acquisition reserves. Pre-acquisition reserves. So therefore, where do we get this? Let's go back to the statement of financial position of Paba, specifically at the equity. At the equity. So at the equity, number 1, we are given the ordinary share capital of Paba. The ordinary share capital of Paba is a figure of 25. Still, in that case, we also have a share premium. Share premium of a subsidiary company, unless told otherwise, is always taken to be a pre-acquisition. Then the retained earnings, which we have there of 5250, that is at the end of the current year. That is not what we're interested with. We're interested with the retained earnings of Paba on the date it was acquired. And that is now what we refer as the pre-acquisition retained earnings. So that one is given in the additional information number 1, whereby we are told when Paba Limited was acquired, its retained earnings stood at 35. And then to this, other than taking now the items in the statement of financial position, specifically at the equity, you also have to check whether this company revalued its asset on the date of acquisition. In case it revalued its asset, was there a revaluation gain or loss? So like in our case, remember here, Paba Limited revalued land with an amount of what? 625. This one we have said is a pre-acquisition revaluation reserve. A pre-acquisition revaluation reserve, which is 625. Yes, I think that's what we have. And basically what we need to do here, we get now the total. So we have 25 plus 1,000 plus 35 plus 625. So this will give us 7625. And because we are using the full goodwill method, we take 100% of this. 100% of this will be 62, that is 7625. We less it from the figure up there. We less it from 10,625, which will give us goodwill on acquisition of what? Over 3,000. So that is the goodwill on acquisition. And remember, that is a full goodwill. Basically, the goodwill determined using the full goodwill what? The full goodwill method. So basically that is what is required there, and basically the items which are marked in such a case are those items which we have there. Then we need to proceed and compute the goodwill on acquisition of the other subsidiary, that is the full goodwill on acquisition of goodwill on acquisition of Dafu Limited. Dafu Limited. So we need to have two columns here, and even before you compute now the goodwill on acquisition of Dafu, it is very, very important for you to note that in Dafu there is no NCI here. There is no NCI because you can see that the parent company acquired all the shares, acquired 100% of the shares issued by what? By Dafu. So therefore in Dafu we don't have what? NCI. And that's why you can see, despite the group using the partial goodwill method, the full goodwill method in computation of goodwill, we are not given the NCI at fair value in Dafu, simply because there is no NCI. So therefore what we do here, we take the cost of investment, the purchase consideration paid by the parent company, that is Pareto, in acquiring shares of Dafu. That one is given in the statement of financial position of Pareto under the non-current asset, which is 750, and then in this case we should add the NCI at fair value, which you are saying is 0 because we don't have NCI. We don't have NCI. We get 5750, and then to this we proceed with less fair value of net assets acquired. Equally, to compute this, we take the ordinary share capital of Dafu plus pre-acquisition reserves plus the reserves it was having on the date it was acquired. So where do we get that? Let's first of all we go to the statement of financial position of Dafu, specifically at the equity section. So the ordinary share capital of Dafu is 2,000. Also Dafu had a share premium of 500 or 500, and then the retained earnings in the statement of financial position of Dafu 5750 is at the end of the current year, but that is not what we're interested with. We're interested with the retained earnings of Dafu on the date it was acquired, and that is given in the additional information number 3. Pareto Limited acquired 100% equity interest in Dafu a number of years ago when it retained earnings. Earnings stood at 1750, and also you check whether Dafu Limited revalued its assets. So basically, as per the information which are given in note number 3, this company revalued its asset, but you're told their fair value was the same with the carrying amount. There was no revaluation gain or loss. So what we do, we get the total here, and then we less that from the figure we have down there. So we have 2,000, which will give us 2,500 plus 1750. So which will give us 4250, and then we take 100% of this. 4250, we less it from this figure minus 5750, which now will give us a goodwill of that, which will give us goodwill of 1500. So basically that also what was required there, and automatically the items to be marked there include what we have there, that, and that. And basically by computing the goodwill on acquisition of the two subsidiaries, the marks allocated there were 4. So let's move to part B of that particular question. Part B, we are required to compute the gain or the loss on disposal of investment in Darfur, investment in Darfur Limited, Roman 1, as it was reported in the individual financial statement of Pareto, as it was reported in the individual financial statement of Pareto. Now, in this case, when Pareto Limited basically invests, or the parent company invests in a subsidiary, to the parent company, that investment in a subsidiary is like an asset. And therefore, once the parent company sells some of the shares, or basically all the shares in a subsidiary, the parent company in its individual financial statement, not in the group account, in its individual financial statement, it will need to recognize the gain or the loss on disposal. Now, that gain or loss on disposal is computed by taking the sales proceeds. The sales proceeds is basically the amount of money which was received by the parent company after selling some of the shares or all the shares in the subsidiary, minus the carrying amount of investment, disposed. Investment disposed, or basically investment sold. And this one is very simple because all these figures are given. So let's go to the additional information number 4, and you're told Pareto Limited disposed 60% investment in Darfur on 1st of April 2021 for 4,700. So that 4,700 is the sales proceeds, the amount of money received. Yes, and then to this, what we know is that the amount of money which Pareto Limited had invested in Darfur is 5750, which is given in the balance sheet of Pareto. The amount invested in Darfur was 5750. In the statement of financial position of Pareto and current asset, the amount invested in Darfur 5750. But in our case, we know the parent company only disposed 60% of that. So that is the carrying amount of the investment sold. So that's how we compute the gain or loss to be recognized in the individual financial statement of Pareto. So this will give us what? 60%, 5750. We less that from 4,700. So this will give us 12 what? 1200. 1200, and basically that is a gain. That is what? That is a gain. That is a gain. So basically by doing that, the candidate here were allocated how many marks? Were allocated 2 marks. 2 marks for computing that. You can see that was quite straightforward. Also, in part B, we are required to compute the gain or loss to be or as it will appear in the group account, as it will appear in the consolidated statement of profit or loss. So this is now the gain or loss to be recognized in the group account. So this is something we discussed in our previous session, how to compute the gain or loss arising from disposal of interest. So in terms of how we compute this, we take a number of figures here. Number 1, we take the fair value of consideration which was received. How much amount did the parent company receive after selling the 60% stake or interest in Darfur? So that figure, we already have it in note number, additional information number 4, and which was 47. And then to this, we add the fair value of investment retained. Fair value of investment which was retained. Still, we have that in note number 4 as a figure of 4,300. The fair value of the 40% equity interest which was retained was 43. After adding those two figures, we proceed and we less two items. Number 1, we less the parent company unimpaired goodwill. Parent company unimpaired goodwill, and that is something we have already computed here. The goodwill arising on acquisition of Darfur, this figure here, And we also have to note that this particular goodwill here, despite computing it using the full goodwill method, this is a goodwill attributable to the parent company, because in this DAFU we don't have NCI, because generally here what we take into account is the parent company goodwill, which is not yet impaired. So this goodwill was not impaired as per the information given in note number 6, and the full amount is the goodwill attributable to the parent company. So that is what we less there. And then we also less the fair value of net assets at date of disposal. At date of disposal. So what was the fair value of the full limited net asset on the date of disposal? That information we also have it in note number 4. We are told on 1st of April 2021, the fair value of identifiable net asset of the full was 6250. Was 6250. So that's how we determine the gain or loss on disposal to appear in the consolidated, or to be recognized in the consolidated statement of profit or loss. So we have 47 plus 4700 plus 4300 minus 15 minus 6250. Is that will give us 1250, which is a positive figure, and that is the gain on disposal. The gain on disposal. The gain on disposal. And actually, that what was required in that part there, and basically by doing this, the marks allocated there were 2. So these are the items automatically which were marked. So let's move to part C of that particular question, whereby we are required to prepare now the consolidated statement of financial position, which you have said is simple, because what we need to do is to appreciate the fact that this will be a subsidiary at the end of the year, and then the full limited at the end of the year, it will be an associate. It will be an associate. So therefore, in preparing a consolidated statement of financial position, we combine similar items of asset and liabilities, those of the parent and those of the subsidiary, and then for the full, we just compute something called the investment in what? In associate. So therefore, let's do that. Part C. So the name of the group here will be is a Pareto group. This is a consolidated statement of financial position as at 30th of June 2021. 30th of June 2021. So here we just need to have a single column, and our figures are in thousands of shillings, in million of shillings. So we start with the non-current assets. So first of all, we have the PPE. So PPE, we are taking the PPE of the parent, recall that, of the parent, that of PABA. We are not including those of DAFU. DAFU is an associate. We don't consolidate asset and liabilities of an associate with those of the parent. What we include here, as far as the associate is concerned, is something called the investment in associate. So therefore, we are only adding the PPE of Pareto and those of PABA. We have 4900 plus 9250, and then we check whether we have any consolidation adjustment affecting the PPE. Do we have any consolidation adjustment? Yes, this one. On the date of acquisition, PABA Limited revalued its asset upward with an amount of 625, which was not accounted for. So we add that here, 625. So remember, we don't have any depreciation other charge, which would have been deducted there. So then below the PPE, we'd have investment in PABA, investment in DAFU. So those investments, we don't include them here, but as far as PABA Limited is concerned, which will be a subsidiary at the end of the year, we include its goodwill here. So the goodwill on acquisition of PABA is 3,000. And then for DAFU at the end of the year, remember, it will be an associate. So what we include here as far as the associate is concerned is investment in associate or investment in DAFU Limited. So in our previous session, we looked on how to compute this, and actually we said to compute investment in associate, we take the investment, that is, we take the fair value of the investment which has been retained. So which is what you are given here, 43. And then to this, what we add is the group share of the post-acquisition net asset in that Darfur. So how do we get the group share or the parent company share of the post-acquisition net asset in Darfur? So what we do is that we take the net asset of Darfur at the end of the year, and basically by now we know that the net asset of a subsidiary is always equal to equity, share capital and reserves. So what is the equity of Darfur at the end of the year from its statement of financial position? You can either take the asset minus liabilities or you just take equity. The total equity of Darfur, which is the same with the net assets, is 8250. This is the net asset of Darfur at the end. But now the date Darfur Limited became a subsidiary, became an associate, sorry, its net asset, you have to recall in note number 4, we were given as a figure of 6250. So therefore, whatever the difference here is the post-acquisition net assets. So we get the parent company share of this, which will be 40%. Which will be 40%. So this will give us a difference of 2,000, 40% of 2,000, 40% of 2,000. This one is 800. We add it to this, which will give us 5,100. So that is now the investment in what? Investment in Darfur, which you are saying will be included here as an item of non-current asset. Okay, so then below that we also have the financial assets. Financial asset, no adjustment for this. We just take the financial asset of the parent, 31, plus those of the subsidiary, 28. This will give us 59. And then from there we have the current asset. Actually, for current asset, we are given the total, 3850 plus 4425. Do we have any adjustment to the current asset? We check for things for like intercompany debts. We don't have things like unreleased profit. We don't have. So mean that no adjustment for this. So what we just need to do, we get the final figure. We get the final figure. We have 3850 plus 4425, which will give us 8275. We get the total assets. The total assets. So let's first of all we compute the figure for PP there. We have 14,900. There is something we have forgotten here before we add here. So this particular purchase consideration which was received, that is a figure for 47. This amount was not yet accounted for. So therefore is amount receivable. It was not yet paid. So we also include it as part of the current asset. We also include it as part of the current what? Asset before we get the final figure there for PP. So let's add 47, 82. 75, 8275 plus the purchase consideration received, this one, which will give us 12,975. Okay, so we get the final figure for PP. We have 49 plus 9250 plus 625. Which will give us 24, that is 24,775. Yes, and then we can add all these figures now, plus 3,000 plus 51 plus 59 plus 12,975. So that will give us a total of 51,750. So these are total assets. So we proceed, record equity. So for equity, we record the ordinary share capital, that of the parent company only, which is the 10,000. The share premium for the parent company only. For the parent company only, 5,000. 5,000. Then from there, we will compute the group retained earnings. This one we computed as the last item. And then we will get the total equity. Total equity, we proceed and compute the non-controlling interest. And the non-controlling interest here will only be computed as far as or in relation to, or we are going to compute this for PABA. PABA is the one which was a subsidiary. Remember, DAFU is an associate. So then from there we have non-current liabilities. So for non-current liabilities, we are given the total. So we have 85 for the parent, and that for PABA. No adjustment here. So we get a total of 14.5. And then we have the current liabilities. Current liabilities, we have 47.75 plus what? Plus 17.25. We don't have any adjustment there. We get total equity and liabilities. Total equity and liabilities. Total equity and liabilities. So let first of all we add these particular figures here. For current liabilities, we have 47.75 plus 17.25, which will give us 65. And then for the non-controlling interest, this one we can compute it directly because the group policy here is to measure NCI at fair value. So when that is the case, then the computation of NCI is quite simple, because what we do, we take the NCI at fair value on the date of acquisition, which is 21.25, plus now the group share. The group share of what? The group share of post-acquisition adjusted retained earnings. So the retained earnings of of PABA Limited after it was acquired, how do we get that? We take its retained earnings at the end of the year. The retained earnings of PABA at the end of the year in the statement of financial position is 50. Hi students, welcome to another session of Manifested Online Classes. My name is Joseph Kimani, lecturer for financial reporting and analysis. So in this session, I want us we continue with topic number 3 with a special focus on subtopic number 5 regarding presentation or preparation of financial statement by cooperative societies. But before you look on the financial statement which a cooperative society need to prepare at the end of the year, we need to know what is a cooperative society, why is a cooperative society formed, and so on. Now, a cooperative society basically refers to an association or an organization which is formed in order to promote the economic well-being of its members. Basically, what that means is that a cooperative society here is not formed in order to provide services or basically in order to sell some goods now to the members of the public with an objective of making profit. So meaning that a cooperative society here is actually formed in order to promote now the economic well-being of the members. So therefore you can say that a cooperative society yes, so therefore in that case you're saying that a cooperative society here will be formed will be formed in order to do what? To promote now the economic well-being of its members and not to provide services or basically to sell goods now to the members of the public in order to do what? To make profit. So mean that whenever, for example, maybe a number of individuals come together, they decide to form something like a circle. Basically, a circle is a good example of a cooperative society. And we know that those particular members will be forming that particular circle in order to make some savings. And if one of the member maybe require a small loan, then he can be able to come to that particular circle and be able to do what? To borrow that particular money. So meaning that the objective of forming that circle is to promote now the economic well-being, to promote now the economic welfare of who? Of the members. Now, whenever a cooperative society is to be formed, a cooperative society is formed and also registered in accordance with something called the Cooperative Societies Act. And basically, once a cooperative society has been registered in accordance with that particular act, then it is recognized as a legal entity, meaning that a cooperative society do have the same status just like a company. A cooperative society can be able to own property. It do have what we refer as a contractual capacity. It can enter into contract on its own name. It can sue or be sued. It can own property and so on. So therefore, a cooperative society do have the same status, just like what? Just like a company. It is a legal entity. Now, according to the Cooperative Societies Act, we have 3 types of cooperative societies which can be registered or which can be formed in accordance with that particular what? Act. So therefore, in this case, we can look on the different types of cooperative societies. Types of cooperative societies which may be registered in accordance with what we refer as the Cooperative Societies Act. Number 1, we have something called a primary society. A primary society. So when talk about the primary society, this refers to any cooperative society which is formed by individual members. And according to the Cooperative Societies Act, for this particular cooperative society to be formed, it must be formed by a minimum of 10 qualified persons. And actually, for a person to qualify to be a member of a cooperative society, according to the Cooperative Societies Act, such a person need to have attained the age of 18 years. Number 2 is that such a person must be a resident or basically must own land within the cooperative society's area of what? Of operation. And number 3 is that that particular person must be within the profession, within the employment within which now the cooperative society is operating. So mean that if, for example, a cooperative society is formed like a coffee farmers, for any person to qualify to be a member, then such a person must be a coffee what? A farmer. So therefore, it is important to note that primary societies are those particular cooperative societies here, which we are saying are formed by individual members. By individual members. And also we are saying that according to the Cooperative Societies Act, for this particular cooperative society to be formed, it must be formed, or basically it is formed by a minimum of 10 qualified members, or basically 10 qualified persons. Number 2, we have something called the secondary cooperative society, or basically we can refer to it as the cooperative union. Cooperative union. In other terms, it can also be known as a secondary society, or a secondary cooperative society. And this is a particular cooperative society which will be formed by 2 or more primary societies. So mean that members of 2 or more primary societies may come together and they decide to register now a certain cooperative society. That cooperative society now which will be registered, or basically which will be formed, then we say it is formed by a primary society. So therefore, cooperative union is a particular cooperative society which is formed by 2 or more primary societies, 2 or more primary societies. Number 3, or the other type of cooperative society is something known as the cooperative union. Cooperative union. So when talk about the cooperative union, this refers to that particular cooperative society which is formed at the national level, basically to promote the growth and the development of what we refer as the cooperative union. So therefore, it is formed at the national level. The objective of forming this particular cooperative society is to promote the growth and the development of cooperative union. A good example of this particular cooperative society in Kenya is what we refer as KUSCO. KUSCO basically is a cooperative society which is formed at the national level to be able to promote the growth and development of cooperative union. So we can say yes. So therefore, what we refer as a cooperative union. Okay, cooperative union. We can use the word Apex Society. Let's rename this. The appropriate name for that, sorry, should be Apex Society. Apex Society, sorry for that, not cooperative union. So therefore, Apex Society, we are saying, is a particular cooperative society which will be formed at the national level to be able to promote now the growth and also the development of what we refer as the cooperative union. So therefore, according to the Cooperative Societies Act, we have those 3 types of cooperative societies which may be formed and also registered in accordance now with the Cooperative Societies Act. Now, our main focus here, as the topic suggests, is basically preparation of a financial statement of cooperative societies. And therefore, which are the financial statements which are prepared by a cooperative society? So we can look on those corporate financial statements. Financial statement prepared, financial statement prepared by cooperative societies. Cooperative societies. First of all, it is important to note here that when we talk about the financial statement, we are talking of the final accounts which are prepared by cooperative societies at the end of the year to basically ascertain their performance, to ascertain their financial position. In this case, we have 3 final accounts, 3 financial statements which are prepared by the cooperative societies, and those financial statements include, number 1, what we refer as the income statement. Income statement, which is also known as a statement of profit or loss. And number 2, we have what we refer as the appropriation account. appropriation account. And number 3, we have a statement of financial position. Statement of financial position. So these are the final accounts which any cooperative society need to prepare at the end of the year. So let's start by looking on what is an income statement and why a cooperative society need to prepare the income statement. So number 1, we have the income statement, which we also referring to a statement of a profit or loss. And as the name suggests, a statement of a profit or loss, or basically what you're referring to as an income statement, this one is prepared to determine the performance of a cooperative society. So mean that in preparing the income statement or the statement of profit or loss, basically what the cooperative society will be doing is basically comparing the income of a given financial year and what refer as what? The expenses or the expenditures incurred during that year. Any difference between the two is actually a profit or what? Or a loss. So therefore you can say that this is prepared. It is prepared to ascertain financial performance. Financial performance of a cooperative society. Of a cooperative society. In other terms, we can say just prepare to ascertain the profit or loss of a cooperative society in a given financial year. So how do we prepare, or how is this statement of a profit or loss presented? So let's look on the format or the layout of what if as a statement of profit or loss. Statement of profit stroke loss. Automatically the one is prepared for a certain year. Yes, so here always we start by recording incomes of the cooperative society. Incomes of the cooperative society. A cooperative society may have various sources of incomes, including things like investment income, and we prepare this account on using vertical format. So a cooperative society may be having something like investment income, things like interest on loans to members. So whenever a cooperative society gives members loans, like a SACCO, the cooperative society will basically, the SACCO will charge some interest. That interest is basically what? An income. So also a cooperative society may be having the other source of income like entrance fees. If you are you want to join a cooperative society, you may be required to pay some fee. So these are some of the good examples of the incomes of a cooperative society, and then from there you get incomes, the total incomes, and then out to this we proceed and less the expenditures. Less the expenditures, or basically the expenses of the cooperative society. And here we basically deduct now the expenses incurred by the cooperative society in a given financial year. This will include things like maybe salaries and wages to the staff, things like management committee allowances, So a cooperative society is managed by a top organ known as management committee. Things like what? The interest on members' deposit. Cooperative societies, mostly SACCOs, they pay interest which is based on members' deposit, because the SACCOs want to encourage members to continue saving with that SACCO. So at the end of each year, as a member, you are paid some interest which is based on your what? On your deposit. So we take into account that. Then we also take into account other expenses like rent, etc. So we take into account all the expenses of the cooperative society, and we less that now from the total the total income. So whatever you get here is now the profit for the year. The profit for the year. So that's how a statement of profit or loss or an income statement of a cooperative society is presented or is what prepared. So next, let's look on what is the appropriation account and why an appropriation account is prepared. Yes, number 2, we have a appropriation account. Appropriation account. So as the name suggests, is this basically an account or a final account which is prepared by cooperative societies to show how the profit for the year is supposed to be distributed to the various stakeholders. For example, this account is prepared to show how much amount was paid to the members as dividends and also how much amount was set aside as statutory reserve fund. Now, it is important here for you to note that under the Cooperative Societies Act, cooperative societies, mostly SACCOs, are required to set aside 20% of their profit as a statutory reserve fund. So therefore, that amount which has been transferred from the profit to the statutory reserve fund, in accordance with the Cooperative Societies Act, it is also shown in this particular account. And therefore, you can say that yes, so this one is prepared to show how the profit for the year was distributed to various stakeholders in form of dividend, in form of transfer to the statutory reserve fund, and so on. So how do we prepare this particular account here? So we can look on the format of the appropriation account. Appropriation account. Yes, so in preparing the appropriation account here, always you start with that particular profit for the year, which was determined after preparing now the income statement. Profit for the year, that's what we start with always. And then to this, we proceed and we less dividends which were paid. So if there are some dividends now which were paid, we come, we less those particular dividends here. We also deduct the transfer to the statutory reserve fund. Statutory reserve fund. And in this case, I've said that the statutory reserve fund, the amount to be transferred to the statutory reserve fund, this one, according to the Cooperative Societies Act, is always 20% of the profit. 20% of the profit for the year. So the examiner may have given that particular information to you, but equally, if you're given a question for cooperative society, that information still is missing, you have to note that 20% is a must, that 20% of the profit for the year must be transferred to something called the statutory reserve fund. And then after deducting those two items, what we do is that we get now the retained profit for the year. The retained profit for the year. The retained profit for the year. To this retained profit for the year, we add the retained profit balance brought down. The retained profit balance brought down. This is the profit which was retained in the previous year. And then whatever you get down here is the retained profit, which is also known as the appropriation account balance. Appropriation account balance carried down. And this particular balance which we have here, this one will be transferred to the statement of financial position as a component of equity. So this one is transferred to statement of financial position as a component, of equity. As a component of what? Equity. So basically that's how the appropriation account is prepared. You can see it is basically prepared to show how now the profit for the year, the profit which was reported during the year was distributed now to the various stakeholders. Finally, I want us to look on how we prepare the statement of financial position. So number 3, statement of financial position. Now, when talk about this one, statement of financial position, formerly known as the balance sheet, this one is prepared to show the financial position of a cooperative society at the end of the year. In other terms, this is a statement of asset, liabilities, and equity, and this one always has to be prepared based on something known as the accounting equation. So we can say that this. Yes, so therefore this is a statement of cooperative societies assets, liabilities, and equity as at the end of the year. As at the end of the year. On the other hand, we can say that it is prepared based on the accounting equation. Yes, so therefore this one we prepare it based on the accounting equation. The accounting equation is an equation which states that assets are equal to capital plus liabilities, equal to capital plus liabilities. So let's look on the format, how we prepare a statement of financial position. And actually this one we abbreviated as SOFP, statement of financial position, which is prepared as at the end of the year. Prepared as at the end of the year. So always we start by recording assets. And when preparing a statement of financial position for a cooperative society, is not a must. There is no need of classifying the asset into non-current and current. Just like what the banks do, we record the asset of the cooperative society starting from those assets which are liquid. When talk about assets which are liquid, we are talking of asset in form of cash, and then followed by those assets which are highly liquid, those assets which can be converted into cash within a short period of time, and finally we record now the long-term asset like the PPE and so on. So therefore, we start by recording assets. In this case, I've said we don't classify the asset into non-current and what? Current. So when recording the asset, what is important here is you start with most liquid assets. Most liquid assets, and finally record long-term assets. So meaning that here we start by recording things like the cash and bank balance, and then next we record things like investments. We also record things like loans to members. Whenever something like a SACCO has given the member some loan, that is an asset. The cooperative society expects the members to repay back those particular loan, and then you finally record the long-term asset, such as now the PPE, property, plant, and equipment. So therefore, I've said here, no need of classifying the asset into non-current and current. And then from there, get the total assets. Next, we record now the capital and the liabilities. And remember what I've said is that the cooperative society here do have the same status just like a company. So therefore, for capital, we record or the capital, which is also known as equity. This comprises of share capital, things like members' deposit, and the reserves. So therefore, let's look on what we record under equity. So next we record equity. And equity, I've said that this comprises of share capital and what? Reserve. So we record the share capital. Share capital. We also have the members' deposit. The members' deposit. So it is important to note that if maybe the cooperative society we are dealing with is something like a SACCO, members will have made some deposit with such a SACCO. But generally, as a member of a SACCO, you can't be able to withdraw that particular amount of money anytime you want. So you can only be able to get back that particular amount of money if now you do what? You want to quit from that particular cooperative society. So mean that particular amount of money which you have deposited with your SACCO remain with the SACCO. The SACCO uses that as capital because mostly SACCOs use that money in terms of giving loans to members. And that's why you can see we are treating that as part of capital. As part of what? Capital. So we record other items of equity like the statutory reserve fund, statutory reserve fund. I've mentioned something to do with this, and then things like the appropriation account, and other reserves like the revaluation reserves, etc. Yes, so those are the various items of equity, and then get the total equity there. Get the total equity, and finally record liabilities. Equally here, when recording the liabilities of a cooperative society, no need of classifying them into non-current and also what? Current. You just record all the liabilities here, which include things like what? Things like creditors. Things like creditors, the amount of money which is owed to the creditors, any accrued expense, etc. Yes. So record all those particular liabilities there, and then proceed. You get what? The total equity and liabilities. Total equity and liabilities. And whatever you get here is the total equity and liabilities, always it must be equal to the total asset, simply because we prepare that statement of financial position based on the accounting equation which states that assets are equal to capital plus what? Liability. So therefore, that's how we prepare or basically present this particular statement of financial position of a cooperative society. So that brings us to the end of that session. In our next session, still in this on this particular subtopic here, we are going to look on an illustration question regarding presentation or preparation of financial statement of a cooperative society. So see you in the next class.
Welcome to our another lesson on Introduction to Microsoft Excel. In our previous lesson, we started on working on how to work with basic formulas and functions in Excel. We looked at the formulas, among them addition, we looked at subtraction, we looked at division, we looked at multiplication, and we also looked at power in cells. So these are the formulas that we looked at last time that we had a lesson. Today, I want us to pick up from where we left and talk about more formulas about the same thing. We are going to talk about average. We are going also to talk about maximum. These are now statistical formulas. We are going to talk about minimum. How do you get the minimum value? We are going to talk about count. We are going to talk about mode. And we are also going to talk about some more formulas here. We are going to talk about standard deviation. Standard deviation, and maybe before I forget, there's also median that is to be done under the statistical formulas on basic formulas in Excel here. So this is what we want to cover, and it will be an extension of the work that you already have. Remember, we had this particular work that we used on our formulas last time. So this one is going to be an extension of what we already covered in our previous lesson. Let us begin by looking at average. So how do you get the average of some marks that you have with you? So average is operated the same way as what we did in the other formulas, like addition and also getting the product. So you can average in cell, you can also be able to average in range. Let us start by averaging in cell. Of course, every formula is preceded with an equal sign, then average, then you double click on average, that will appear there. Then you can click on the cell that you want, or you can type it manually. So in our case, let us click on, we want to get the average of Tom. So I'll click on 65. Then now we separate them with commas. So 65, then comma, 84, then comma, 70, then comma, 76. And if that is the end, you close the bracket, shift and the sign of closing the bracket on the keyboard. After that, you enter, and it will give you the average for Tom for all the units as 73.5. So this is the average, and you can be able to copy it down all the way to the last one, which is not Juliet. I believe there is something wrong there. On our product in our previous class, I believe we might have included wrong items. Let me just confirm what we did. Okay, that seems to be okay. It's all fine. So up to the last one, who is Tony. So we've gotten the average of Tom all the way to the average of Tony. I can undo, and I can start again by getting the average. Of course, equal sign, then average. You double click on the average. Then after double clicking on the average, you can type manually like B10, you can see it's highlighted, comma, C10, comma, but that's a long way. If you want to move faster, you just click on them. So 65, comma on the keyboard, 84, comma, 70, comma. Remember, if you want to jump one, you can always jump. Assuming that you never wanted the one for auditing, you can always jump and you click on the last one. So this one is now excluded in your average for that particular period, and you can see the average has reduced. So there's also another way, of course, average in range. So again, average, and you just select average in range. You select up to where you want, up to 76, then shift and you close the bracket. So that is average in range. Then you enter to get 73.5, from which you can be able to drag down your formula all the way to what you want, up to Tony, and you'll get all your averages for that particular student. You can also get average here, if you so wish, average and equal sign, or let us use now the other aspects. You can go to the formula place, AutoSum. If you see average, you click on average. There is average here, but this one will pick everything. You can see up to the next place where there is nothing. So this one majorly picks everything, but you can be able to highlight up to where you want, that is up to Tony, and it will give you everything that you want. If you enter, of course, the average is 66.60. You can undo, and again, in the formulas, you can use the insert function. You click on insert function. What do you want? You want average. Like that. So go, and you will see average highlighted here. Just click on it. Okay. Then you confirm whether B17 to B19 is what you want. B17 is just 15 subtraction, then B19 is just this one. So it's wrong. It means you can deduct or you can do away with it and select whatever you want to get the average of. So you just select, you can see it is moving all the way to Tony, and your average is set. So the average is set once you have done the correct thing. You click on OK, and you can see the answer is still 66.6. So whichever approach you use, of course, the average is still going to be the same as in any other case. Average, you can see the answer is still 66.6. So you then drag across all the way to MA, so that you can have your average up to MA. So that is the average of those particular items. Having done the average, the next thing is maximum. Now we want to do maximum. What is the maximum? What is the maximum? Maximum is the same as highest. Maximum is the same as highest. So we are looking for the highest value in our set of data under financial accounting. So equal sign, then max. So you look for the function of max. This one returns the largest value in a set of values, and it ignores values and logical values and texts. Of course, this one is max. Then which one is the highest value? The highest value up to there. Then you close the bracket. This one gives you 88. So you can see in this set of data up to here, 88 is the highest value which has been returned by this. So if you copy across, it also gives you the other highest values in, like in this case is 84. In this case, you can see it's 70 is the highest value here. In this case, the highest value can clearly be seen to be 76, of course. So that is highest value using max. What about lowest value? How do you get the lowest value? Of course, when using the lowest value or getting the lowest value, you use mean. So we are going to use mean to be able to get the lowest value. And again, you highlight all the way to this one. And the lowest value there is that one. So the lowest value is 50. The formula is saying that it's 50. Let us see. The lowest value, indeed, 50. Here there is nothing, so it cannot count that. So 50 is the lowest value. There are two 50s, so we'll just pick any. What about these other cases? You can drag across and get your lowest value. Again, here they are saying it's 50. Let us confirm. The lowest value is indeed 50 from this set of data. It is 50. What about 34 here? Is the lowest value 34? Indeed, yes. The lowest value is 34 from this set of data. Even here, of course, the lowest value is 24 from this set of data. It is 24. So that is the lowest. If you want to get the lowest value using minimum. Now we want to move to median. How do you get the middle value? Middle value, of course, we'll be using median. Equal sign, then we do median. So you double click on the median and you can be able to get the lowest value in that set of data, median. And that is median. Is it the median? Of course, when getting the median, Excel arranges from the lowest to the largest and then accesses the median value. So if you arrange these items from the lowest to the largest, the median value will be 65. So let us copy across and see which is the median value in the other cases. You can see the median value in these other cases here. So that is median, which helps us to get the middle value or the midpoint. So after the median value, we can also be able to get mode. Mode simply refers to the most occurring. So most occurring, that is mode. Most occurring. So let us see, how do you get the most occurring in mode? So you can see mode, the function is available for this one returns the most frequent occurring or repetitive value in any array or range of data. So this one returns the most occurring. So again, we want to select here and get the most occurring in a set of data. And the most occurring that set of data is 50. Let us see if 50 is most occurring from here to here. Yes, 50 occurs twice. So 50 is the most occurring. If you copy across, you can see that it gives you 50 again here. And indeed, 50 is the most occurring, 50 and 50. But here, the answer is not available. That means there is no most occurring. So So there is no most occurring here. There is no figure that is repeating itself in this set of data. So there is no most occurring. Even here, there is no figure that appears more than once. So there is no most occurring in this set of data. So that's why the answer here is not available. And indeed, that is the that is the correct answer, not available. After that, you move to another formula. After most occurring, which is mod, we can be able to get the standard deviation. Standard deviation. Of course, standard deviation is equal sign then STDEV. That is the formula that you use for standard deviation. What is standard deviation? You can see it says estimates the standard deviation based on the sample. It ignores the logical values and text in the sample. So that we want to get the standard deviation of this set of data from here moving the way to this place. Then you close the bracket and this will give you a B10 to B15. If you enter, it returns the standard deviation as what you can see there. So that is the standard deviation. If you copy across, it gives you the other standard deviations from the other set of data there. So those are the other statistical formulas, basic of course for beginners, that you can be able to use in your work. You can be able to use to manage your work, either if you are a student or if you are working somewhere. These are the functions that are usually used when doing a lot of statistical and also mathematical tasks. There's an Excel file that is attached below the video description, which will use for your assignment. So make sure that you go through it and redo almost everything that you've done, almost everything that we've gone through in this particular lesson. Thank you, and see you in our next lesson.
Welcome everyone to the lesson. The subject is known as communication skills. The topic is a new one, namely group and team communication. This topic has 5 sections. The first one is group communication networks. Number 2, team communication. Number 3, communicating in virtual groups and teams. Number 4, meetings. Number 5, conferences and symposia. In our today's session, we are going to study the first section, which is group communication and networks. Group communication networks. Group communication networks. That is our area that we are going to focus on today. So by the end of this lesson, you should be able to explain various group communication networks. Now, candidates, let's first define group communication. Now, group communication, just as the name suggests, it takes place when there are more than 2 people involved. If you have minimum of 2 people communicating, then you say that is group communication. It takes place where there are more than 2 people involved in communication. The number of people will be small enough to allow each participant to interact and converse with the rest. So in a group communication, every member of the group has an opportunity to communicate. So the number should be small enough to allow everyone to contribute. Things like press conferences, board meetings, team meetings are examples of group communication. And unless a specific issue is being discussed, small group discussions can become chaotic and sometimes difficult to interpret by everybody. Group communication. So what are these group communication networks? We've defined group communication. How about communication networks? Group communication networks. Candidates, a group communication network or just communication network refers to the method in which employees pass on information to other employees in an organization. And communication can flow in a variety of directions within the organization. That is what we are referring to as internal communication, and can flow between also organizations. Information can flow within a company where, for example, a finance department communicates with the, say, sales department internally between employees. Information can also flow between the organization and its constituents, between the organization and external organizations. Now, candidates, in an organization, members contact each other. And the pattern of contact and flow of information is what we are referring to as communication network. Communication what? Network. So in this lesson, we're going to discuss 3 communication networks. 3 communication networks. The first one is the chain network. Chain network. The second one is known as the wheel network, and the third one is the all-channel network. All-channel network. But let's first describe the chain network. Now, under this network, the chain network, candidates, the members in the network transmit the members transmit messages via one person at a time, via one person at a time. Members transmit messages via one person at a time. Members transmit, let me put down that, members transmit messages via one person at a time. Members transmit messages via one person at a time. And this is how that chain looks like. The members transmit messages via one person at a time. One person at a time. So if this member has a message, that message is transmitted to this member. Then this member again transmits the message to the next member, one person at a time. One person at a time. One person at a time. The formal chain of command is strictly followed. The chain network. That is the chain network. Now, the second communication network is known as the wheel network. The wheel network. The wheel network. Now, candidates, here, under the wheel network, the leader plays the key role. The leader does what? plays the key role. And how does the leader play the key role? Other members depend on the leader for group communication. What does that mean? That means that the members route communications to and through one person. Wheel network, the wheel network. And this is how the wheel network looks like. That is the wheel network. The wheel network. The leader here plays the key role. This is the leader. All these members pass messages to each other through the leader. Here we have the leader. He plays a central role, the key role. Members depend on the leader. If this member has a message for this member, then that member here must wait for the leader to get the message from this member. If this member has a message for this member, then this member has to rely on the leader to get the message from this member. The leader does what? Plays the key role. Members route communications to and from the leader. To and from the leader. And this we have seen it in, say, in projects that require very close supervision. The projects that require very close supervision will use the wheel network, communication network. Members route message through the leader. They receive the messages through the leader. This is the wheel network. Wheel network. I've said that the wheel network, I repeat so that you remember, the leader plays the key role. Members depend on the leader for group communication. Members, let me write it. Members depend on the leader for group communication. I've also said that members route messages to and from the leader. Members route messages to and from the leader. That is the wheel network. Then let us see how the third network looks like. We are moving on to the all-channel network. All-channel network. All, this is number 3, all-channel network. All-channel network. Now, the all-channel network may also be referred to as the circle pattern network. Circle pattern network. It's also known as the circle pattern network. Also known as the circle pattern network. Now, under this communication network, this network allows all group members to communicate with each other freely. It allows all members in the network, in the group, to do what? To communicate with each other freely. The circle pattern network or the all-channel network allows all members in the group to communicate with each other freely. That means that every member talks directly to everyone. All right? Every member talks to each other freely. And this is how we can demonstrate it in a diagram. So you can see candidates. That is the all-channel network. This member can communicate to this member, can communicate to this member, can communicate to this one here. So this member can communicate to this member, can communicate to this member, can communicate to this member, can communicate to this member. This one you can see communication is flowing in all directions. 1, 2, 3, 4. This one again you can see 1, 2, 3, 4. This one 1, 2, 3, 4. All members in the group can communicate with each other freely. It allows all members to do what? To communicate with each other freely. So these are three group communication networks. Just to recap what we have done today, candidates, we've introduced the chapter Group and Team Communication. We've defined communication networks. We have defined in our today's lesson group communication. We firstly defined group communication, then we defined group communication networks. We've gone ahead to describe three communication networks, three group communication networks. The first one is the chain network. We say that under the chain network, members transmit messages via one person at a time. This member cannot receive any message apart from this one. And this one has to wait for information to come from the first member. So we say that it strictly follows the chain of command, strictly. This member cannot communicate directly to this one. This member cannot communicate directly to this member or this member. This one has to wait for message from this member. This member has to wait for information from this member. This member has to wait for information from this one. And this one relies on the first member for messages. Members transmit messages via one person at a time. We've also described the wheel network. We said that the wheel network, the leader plays the key role. Here, this leader plays the key role. All the members depend on the leader for group communication, whether it is relaying information or or receiving information. All members must wait for this leader for information. Members route communications to and through the leader, to and through the leader, to and through the leader. The wheel network. We also described the all-channel network, which we said is also known as the circle pattern network. We've seen how the information flows here. We've said that this network allows all members in the group to communicate with each other freely. Members can interact freely. Every member talks directly to everyone else in the group. And here, candidates, this network is mostly used where teams have similar job functions, such as engineering, such as construction of projects. Such jobs may rely on the all-channel network. Okay? Members can communicate with each other freely. So that will mark the end of the lesson. I'll give you one question as your assignment. Describe 3 group communication networks. Thank you for attending today's lesson. I hope to meet you in our next lesson, where we continue to study more in relation to group and team communication. Bye-bye.
This one is the C. We have borehole, security wall, water tanks. Such are the one that we give capital allowance at the rate of 50%, 25% under the manufacturing. So now that we are done with manufacturing, we go to number 2. Still, those at the rate that we had indicated up there. So these are the following items. Used in farming. The key thing, farming. So if you are doing farming, or a business is doing farming, and it incur the following costs, it should claim capital allowance at the rate of 50%, then 25% when they are determining the taxable income. What are those items? These are the one under farming. A, we have farmhouse. Now, for the farmhouse, it is very important for you to note that, I'll put it into bracket, note, only a third of the costs qualify for partnerships and sole proprietorship. For limited companies, the whole cost qualify. So when you're talking about farming, the first item that qualify for capital allowance at the rate of 50, then 25 is the farmhouse. Farmhouse is where the owner of the business stays when they visit the farm. When they construct it, when they are claiming capital allowance, if they are doing the farming as partnership business, we are going to look at later what we mean by partnership, and also proprietorship business as a loan, they are supposed to take just a third of the cost, and that is the one that they compute the capital allowance on the rate we have talked about. However, if it is a limited company, don't take a third. Take the whole cost and give it the capital allowance at the rate that we have talked about. That was an A under the farming. So we go to B, still under farming. So I'll delete this one. Is a continuation of 50%. B, so we are still under farming, is the cattle dip. Cattle dip. The next one, cow sheds. spots. Feeding troughs. Irrigation networks. We have the water system, electricity system, and sewerage systems. All these are together as system. Sewerage. H, any other structure necessary for the operation of the farm. So when you are doing farming and you incur those costs, then know that you are supposed to claim capital allowance at the rate that we have talked about, the 50%, then 25%. Remember, that was under number 2 of the 50%. From there, we go to number 3, still under 50%. So number 3, under 50% still, we have the following items. Used or incurred in mining. So the key thing here is mining. Remember, so far we have looked at 50% and then 25% under 3 headings. So far we have done under manufacturing, we have done it under farming, and now we are in mining. So under mining, which items qualify at the rate that we have talked about? So these are, so we have cost incurred in searching, testing, and accessing minerals. So I'll list them, then I'll explain to you. We continue here, still under mining. We have B, still under mining, costs incurred in order to get rights over minerals. C, mining machine. Mining machine. D, the following buildings. Related to mining, i.e., we have staff quarters, staff clinic, staff canteen, warehouses, etc. After that, E, we have the following costs: incurred before mining started. or before mining start. So those are the cost under mining that we normally give the rate that we have talked about. One of them is the cost that are incurred in searching, testing, and accessing the minerals. So if you are a mining company, before you start mining the minerals, you need to determine what quantity of the minerals are there. You incur the cost of searching, and then what is the quality. So you test, and then you access. Some are usually deposited underground. In that case, you have to drill so that you can be able to access. All these costs are the one that you are calling the cost that we give the rate that we have talked about, the 50, then 25%. The next one is the cost incurred in order to get the rights over minerals. As per the laws of Kenya, it says that if you buy land and you realize that there are minerals there, gold, silver, name them, you cannot start mining until you get the government permission. Government permission is usually through government giving you a license that you are allowed now and or license to start mining. So when you are getting that license, you have to pay to the government. In that case, that cost or the money that you have paid, you will claim the capital allowance at the rate that we have talked about, 50, then 25. Then the other one is mining machines that are used to mine minerals. Also the foreign buildings related, the key thing is related to mining. So as long as a building is related to mining, you should give it under mining 50, then 25%. These are staff quarters, staff clinic, staff canteen, warehouses, any other building. As long as it's related to mining, then in that case you give it the rate we have talked about. Then the last one is the foreign cost incurred before mining start. The key thing there is before mining start. So if the cost is incurred after you start mining, those won't qualify. And I want to expand on that and give you a list of the expenses that are incurred before mining started. That is administration, so i.e. administration, consultancy, and management fees. Management fees. So all these are expenses that can be incurred before the mining start, and all of them you are supposed to give them the capital allowance at the rate of 50%, then 25%. So those one are under the heading of mining, which was the third one. Now we go to the fourth one that still we give at the rate that we have talked about, 50%, then 25%. So number 4, we have ships, aircrafts, we have hospital buildings, hotel buildings, hospital equipment, hospital equipments. All those are supposed to be given under the rate of 50% and 25%. And that is the end of those items that we give 50%, then 25%. So I want you to remember that 50% are under 4 headings. The first one is manufacturing, the second one is farming, the mining, and now number 4 is a composition of several items: ships, aircrafts, hospital building, hotel buildings, and hospital equipment, and it ends there. From there, there's something I want you to note about the 50%, then 25% before we go to the second rate, which was supposed to be 25%. Note. Number 1, cost of land. Cost of land and land related costs do not qualify for capital allowance. Very important that when you buy land, either to construct a factory building, to do farming, to do mining, to construct the hostel or even the hotel buildings, all these we should not give them the capital allowance at 50 or 25. Actually, land doesn't qualify for any capital allowance. We usually ignore, we don't give it capital allowance because land is always there. It does not lose value, so it's always there, so we don't give it the capital allowance. That is note number one. Note number two about the capital allowance. In the factory building, or industrial building, if the following, I want to delete this part so that I can continue. If the following buildings are part of factory or industrial building, they are excluded when computing capital allowance. Because they are not part of manufacturing. I.e., we have offices, staff quarters, warehouses, staff clinic, staff quarters, we have etc. among others, but maybe I can add here shops, exhibition halls, among others. As long as they are not used in manufacturing, we don't normally give them together with the factory building, so that you may find that you are told we have the factory building which was constructed. So we assume this the factory building, and we are told that it costed 100 million. But part of this, that's the whole of it that costed the 100 million. But now part of this one is used for other purposes other than manufacturing. Like you can be told this was a warehouse, this was an office. So when you are claiming capital allowance, exclude the part that are not used for manufacturing, like these ones. So you must know which cost were they. So like you can be told this one was 70 million. So in total now the office and the warehouse. So when you're claiming capital allowance on 100, it will be the one that you now claim will be 100 minus 30. 70 million is the one that you claim 50% first year, then 25% straight line basis from the second year on the remaining balance on the 70, not 100, because these parts are not used for manufacturing in that particular factory building or industrial building. That is the end of capital allowance at the rate of 50%, then 25% per annum straight line basis from the second year on the remaining balance. We go to the second rate, that is the capital allowance at the rate of 25% per annum straight line basis. So I'll have to delete this because we are done with that 50, so that now we can have the 25%. So we have the second rate.
Hello candidates, I hope you are doing fine. Welcome to our today's learning session. In our today's lesson, we want to do a further illustration on the topic preparation of financial statements of partnerships. We'll answer a question here. The question reads as follows. Pete and Chanda have been in partnership, sharing profits and losses in the ratio 3:2 respectively. The agreement also provides the following. Bullet 1, interest be allowed on capital at the rate of 10% per annum. Bullet 2, interest be charged on drawings and current accounts with debit balance at the rate of 10% per annum. Bullet 3, Chanda is entitled to a salary of 1.2 million shillings per year. Their trial balance after preparation of trading account on 31st March 2017 was as follows. Capital accounts, Pete 6 million, Chanda 3 million. Current accounts, Pete 2 million, that is credit balance, then Chanda debit balance 1 million. Drawings, Pete 3.6 million, Chanda 2.4 million. 10% loan from Pete 4 million, 12% loan from Boresha Bank Limited 6 million. Gross profit for the year 16 million. Inventory as at 31st March 2017 3.2 million. Administrative expenses 3.8 million. Sales and distribution expenses 6.2 million. Freehold property at cost 10 million. Motor vehicles at cost 6 million. Accumulated depreciation on 1st of April 2016, freehold property 1 million, motor vehicles 2.4 million. Interest on banco paid 360,000, accounts receivable and accounts payable 4.8 and 3 million respectively. Bank balance 2 million and 40,000. Additional information number 1, the following balances were available as of 31st March 2017. Accumulated, this is accrued administrative expenses 200,000. Sales and distribution expenses prepaid 1.2 million. Number 2, a half-year interest on loan from bank is owing. Number 3, depreciation is provided on cost as follows. Asset, freehold property 5% per annum, motor vehicles 20% per annum. Required. A, income statement and appropriation account for the year ended 31st March 2017, 10 marks. B, partners current accounts 4 marks. C, statement of financial position as at 31st March 2017, 6 marks, total 20 marks. 20 marks, so we are going to answer this question. The partnership is, the partners are known as Pete and Chanda. Pete and Chanda. We are to prepare the income statement and appropriation account. Income statement and appropriation account for the year ended, 31st March 2017. That is part A of this question. And we'll have 2 columns for shillings, the amounts. The income statement and appropriation account. Looking at the trial balance, I can see below the 12% loan from Boresha Bank, there is a gross profit for the year. That means we are not going to prepare the trading account because the gross profit has been provided. We prepare trading account to get the gross profit. But in this case, the gross profit has already been determined. What we'll prepare is the net profit. we'll prepare the profit and loss account to determine the net profit. Then we'll appropriate the profit, because remember, partners are in business to make profit. And when the profit is made, they have to share the profit depending on the profit sharing ratio. If the partnership for one reason or the other incurs loss, then the partners also will share the loss according to the profit and loss sharing ratio. So let's find out, did this partnership make profit or loss? So we are going to start with the gross profit, then we deduct the expenses to get the either the net profit or the net loss. So the gross profit here is 16 million. 16 million is the gross profit. We will check for any other income other than this gross profit. Any other income from the trial balance will appear on the credit side. Incomes have credit balances. So the credit side, I don't see any other income. So we will straight away check for the expenses. There is no any additional income like the rent received, the commissions received, and discounts received. If that was in this question, we would have added it to the gross profit. But since there is no any other income, we will deduct expenses from this gross profit. Expenses, and always candidates note that expenses are in two categories: expenses that require adjustments and expenses that do not require any adjustments. Expenses that require adjustments will always appear under additional information, like note number 1, the following balances were available as of 31st March 2017. 31st March 2017 is the end of the accounting period. The accrued admin expenses 200,000. So we will have working for workings here. We'll have our workings. The first one is admin expenses. Admin expenses account. Admin expenses account. There is a accrued balance at the end of the accounting period. But if you are to check the trial balance, the admin expenses amounted to 3.8 million. So we will debit this account first with the 3.8 million. 3.8 million. Then the additional information, admin expenses at the end, we add to the expenses that were paid. That is balance carried down at the end. It's 200,000. So the balancing figure will take to the income statement, and it's 4 million. This is 4 million. 4 million. There are 3 zeros here. That is the first working. The second working, below admin expense, we have the sales and distribution expenses. Number 2, sales and distribution expenses account. This account, from the trial balance, we see just below admin, the amount that was paid, the bank was credited with 6.2 million, 3 zeros here. When the sales and distribution expenses were paid, the bank account was credited and this expense account debited. Then note number 1, sales and admin expenses prepaid. Prepaid at the end of the accounting period, we deduct from the amount that was paid. Prepaid means that the sales and distribution expenses were paid in excess. So if they were paid in excess, then we deduct by crediting this account at the end. The amount is 1.2 million. There are 3 zeros there. So the balancing figure is what we'll take to the income statement. And I can see here It's 5,000. 6.2 million. Close that account. 6.2 million. That is the second working. Third working, note number 2, half-year interest on loan from bank is owing. From bank is owing. So we have number 3, bank interest. Bank interest account. The bank interest account we see from, do we have the bank interest account from the trial balance? Yes, there is that 360,000. This account was debited with 360,000. There are 3 zeros there. Then note number 2, half-year interest on loan from bank is owing. We know the interest rate, the annual interest rate from the Boresha Bank is 12%. The annual interest should be 12% times the interest amount, which is we multiply by the loan amount is 6 million. 12% of 6 million. This is the annual interest. Taking my machine, 12% of 6 million. 12% times 6 million. This is equal to 720,000. This is the amount that ought to be paid, but from the trial balance only 360 was paid, meaning the difference which is 360 was owing at the end of the accounting period. So owing at the end, just like in this case of admin, we debit at the end. This is balance carried down 360. Therefore, the amount to transfer to the income statement is 720,000. 720,000. 720,000. That is not number 2. Moving on to note number 3. Note number 3. These are expenses that require adjustments. Note number 3, number 4, working number 4, depreciation. Depreciation. There are 2 machines that ought to be depreciated. Freehold property at the rate of 5% per annum. So freehold property, 5% times the cost of freehold property from the trial balance. Freehold property 10 million. This is 10 million. Then motor vehicle is 6 million and is to be depreciated at 20%. 20% times 6 million. This is motor vehicles. So I have 5% times 10 million. This is equal to 500,000. This is 500,000. 500,000. There are 3 zeros there. 500,000. Then 20% times 6 million. It's 1.2 million. That is depreciation. Note number 3. So these are expenses that required adjustments to be adjusted. So I'll come here and document admin expenses working 1. Admin expenses working 1, 4 million. Next, sales and distribution expenses working 2, that is 5 million. Next, I have bank interest. The the working is 3, bank interest 720,000. Next, I have depreciation. Depreciation on freehold property, working 4, depreciation 500,000. Motor vehicle depreciation, the amount is 1.2 million. 1.2 million. Then I can check for the expenses that do not require any adjustments. Going through the question, I can see the 10% loan from Pete. Pete is a partner. Pete has loaned the partnership 4 million at the rate of 10%, and that is not indicated anywhere in the trial balance, and also the question is silent on the partner's loan. But we know if a partner has loaned the partnership, that is a normal expense. The loan interest, okay, the loan interest from money advanced by Pete should be treated as a normal expense. It has to be expensed from the income statement, and the rate is 10%. The rate is 10%. The amount is 4%. So 10% of 4 million, 10% times 4 million, this is equal to 400,000. 400,000 is the annual interest that the company should pay Pete. So that should be expensed first from the income statement. That is loan interest from, this loan is from a partner, Pete. The amount is 400,000. That is the first expense I see there after just before 12% loan from Boresha. Then there is a gross profit, there is admin expenses there, sales and distribution expenses, freehold property. Moving on to interest on bank loan, there is accounts receivable bank. There is no any other expense. Those are all the expenses. So let us get the total expenditure. 4 million plus 5 million plus 720 plus 500 plus 1200 plus 400. Total expenses 11,820. We'll deduct these expenses from the gross profit, deduct 16 million. So the net profit is 4,180,000. That is the net profit. Net profit. So candidates, this is the net profit from operations. Now if I were to take you back to the agreement, the partnership agreement, we read that the agreement also provides the following. Bullet 1, interest to be charged on capital at the rate of 10%. The bullet 2, interest to be charged on drawings and current accounts with a debit balance at the rate of 10% per annum. Interest to be charged on drawings. Drawings will constitute either the money or the goods that the partners take away from the partnership. They are the owners, but they may withdraw money from the partnership, or they may draw goods from the partnership. When that happens, the partners have agreed that at the end of the year, if there is any drawings made by the partners, then the partners will have to be charged interest. We are calling it interest on drawings at the rate of 10% per annum. So we need to check from the trial balance, do we have any drawings? And I can see there drawings, because this is trial balance as at 31st March. There is drawings. Pete has withdrawn 3.6 million. Chanda has withdrawn 2.4 million. So these drawings, the partners have to pay. And if they are paying the partnership, then that will be added to the net profit. So we'll have interest on drawings from both Pete. We have seen there is a balance, Pete, there is also Chanda. So I'll come here and have a working number 6, I'll call it interest on drawings. Interest on drawings. First is Pete, 10% times, we apply 10% on the amount that was withdrawn, which is 3.6 million. 3.6 million. Then Chanda, again 10% times the amount withdrawn, 2.4 million. 2.4 million. So let's calculate 10%. 10% times 3.6 million. This is equal to 360,000. Then 2.4 million times 10% is 240. 240 million. 360, 240. So we'll have 360, 240. That is interest on drawings. Other than interest on drawings, candidates, we read that interest will be charged also on current accounts with debit balance. Current accounts with debit balance. This is interest on current account. And checking the current account from the trial balance, you can see there, candidates, that Chanda has a debit balance of 1 million. The current, under current accounts, Chanda's 1 million appears on the debit side of the trial balance. That means that Chanda owes the partnership 1 million. His account is overdrawn by 1 million. But Pete's account is a credit, has a credit balance. Pete's account has a credit balance. That means that the partnership owes Chanda 2 million. The partnership owes Pete, not Chanda, but Pete, owes Pete 2 million, but Chanda owes the partnership 1 million. So a credit balance means that the partnership owes the partner, but a debit balance would mean that the partner owes the partnership. And if a partner owes a partnership at the end of the accounting period, the partners agreed before they started up operations that interest will be charged on current accounts with debit balance. So working number 7, we will call it interest on current account. Interest on current account, and we have seen the rate is 10%, and the debit balance on Chanda's account is 1 million. 1 million shillings. Therefore, 10% of 1 million will be equal to 100,000. 10% times 1 million is equal to 100,000. 100,000 shillings. That is an income to the partnership, and that's why we add it to the profit. This is working number 6. We are now on working number 7, interest on current account, working number 7. This is Chanda 100,000. So all these are incomes to the partnership. We need to add 360 plus 240 plus 100. This is equal to 700, which will add to the net profit of 4180, giving us a total of 4,880,000. This is the amount that is now available to the partners. The partnership made a profit of 4,180,000. Then the partnership made money from the drawings of the partners and the debit balance on the current accounts, total 700. So what is now available is 4,880,000. This is amount that we will now appropriate according to the partnership agreement. So up to this point, we've done the income statement. So we'll now come here and appropriate. This is appropriation. Appropriation account. Remember, the question reads that part A, income statement and appropriation account. We will now want to distribute this money based on the agreement. The amount that is available is for appropriation is 4 million. Let me have it in 2 columns. Let me have 2 columns. Appropriation account, 2 columns. 2 columns. Appropriation account, 2 columns. The amount that is available for appropriation, let me transfer this here, 4,880,000. So candidates, the 4,880,000 is the amount available for appropriation. Amount available for appropriation. And how is the appropriation to be done? We check the agreement. Remember, the partners came together to make profit, and they must have agreed on how they will appropriate any money that is made. Looking at the agreement, bullet number 1 says interest be allowed on capital at the rate of 10% per annum. So we are going to pay each partner interest on capital. They invested capital in the firm. They are entitled to an interest of 10% on the outstanding balance on the capital account. So I'm going to have working number 8, interest on capital. We begin with Pete. We'll apply the 10% on the outstanding capital account balance of 6 million. Then we'll pay Chanda 10%, the outstanding the outstanding capital account balance 3 million. 3 million, 6 million. 3 million, 6 million. So 10% of 6 million, 10% times 6 million, 600,000. 600,000. Then this will be 300,000. 300,000. There are 3 zeros there. 300, 600. So first pay interest on capital, interest on capital, Pete, how much? 600,000. Chanda, how much? 300,000. Then again, other than interest on capital, the third bullet, Chanda is entitled to salary. So we pay salary. Chanda should be paid salary of, this is a total of 900. Chanda's salary 1.2 million. 1.2 million. These are deductions. Make the payment. Pay. After paying, you'll have a balance of 900 minus 1200. This is equal to 2780 is the profit to be shared among the partners. Profit to be shared. And how is the sharing supposed to be done? Again, the partners agreed that the profit and losses will be shared in the ratio of 3 to 2. So working number 9 is profit sharing. And they are going to share this profit in the ratio of 3 to 2 respectively. Pete, that means Pete will take home 3/5 times 2780. 2780. Then Chanda will take home 2/5 times 2780. That is how this money will be shared. Times 3 divided by 5. 1,668,000. There are 3 zeros there. Then 2780 times 2 divided by 5 is equal to 1,112,000. That is how they will share the profit. This is the profit that is to be shared. And Pete will take home 1,668,000. Chanda 1,112,000. This is equal to 2780. When you deduct 2780 from this 27, there is no balance. All the money has been shared. So that is the income and appropriation, income statement and the appropriation account. That is the answer. Then part 2B, partners' current accounts. We are going to prepare the partners' current accounts. The partners are Pete and Chanda. Will prepare partners' current accounts. Partners' current accounts as at 31st March 2017. So we'll have two sides of this partnership account, partners current accounts. On this we'll have Pete and Chanda, Pete and Chanda, Pete, then Chanda. come here and have Pete and Chanda. Pete, Chanda. Shillings, shillings in thousands, shillings in thousands, shillings in thousands. These are accounts, partners' current accounts. This is Chanda's current account, Pete's current account, the debit side. Then we have the credit side. That is the credit side. This is the debit side. So we will first record the balances as they appear in the trial balance. Balance brought down on Pete's account is 2,000, and you see it's on the credit side. So we need to record balance brought down on the credit side, Pete's account 2 million. On Chanda's account, the balance is on the debit side, so we record on the debit side, balance brought down 1 million, nil, nil. So one partner has a debit balance, the other partner has a credit balance at the start of the accounting period. And remember, we say that a debit balance on the current account means that the partner owes the partnership. The partner has overdrawn, has taken in from the company, from the partnership in excess of what the company owes him, or the partnership ought to pay him or her. Remember, candidates, we said that a credit balance on current account means that the partnership owes the partner. In this case, the partnership business owes the partner Pete 2 million. And a debit balance on current account, like in this case here where we have current debit balance on Chanda's account, means that Chanda, the partner, owes the partnership 1 million. And that's why we read in second bullet that interest is to be charged on current accounts with debit balances. This partner has a debit balance on this account, and he will have to pay some interest on that because he's holding the partnership business money. He's holding money, and by holding this money, he's denying the partnership capital. So if he's holding capital, then he has to pay some interest on that. That's what the partners agreed on. So we are preparing partners' current account. First, we have indicated the balances at the start. Then this current account, these current accounts will be credited with the amounts pays or gives the partners, like from the appropriation. Okay, most of the entries that appear in the partners' current accounts, most of the items are either debit or credit entries from the appropriation account. If you want to enter transactions in the current accounts, you simply check the appropriation account, because this is where we have the corresponding double entries. For example, the interest on capital. We debit the appropriation account and credit the current accounts. So here we have interest on capital. So we'll credit interest on capital. Chanda, we have Pete and Chanda. Pete and Chanda. Pete and Chanda. So Pete 600,000. that is Pete, then Chanda 300,000. 300,000. So we have credited the current accounts. Why have we credited the current accounts? Is because this interest was debited on the appropriation account. The appropriation account, candidates, we prepared it in vertical format, but if you are to do a horizontal format of the appropriation account, then we'll have the amount, this amount of 4,880,000 on the credit side. This is the net profit, or the profit, profit plus the additions gave us that. In appropriation account, where you have done it in a horizontal format, then this interest will appear on the debit side. Interest on capital will appear on the debit side. So we credit, we debit the appropriation account, debit, this is the debit side, and credit, this is the credit side. We credit the partner's current accounts. So that is one entry. Then we move on to the other one, the salaries. Salaries, if you are to do it horizontally, salaries will appear on this side. So salaries account, the money that was paid to Chanda 1.2 will again appear on the credit side of the current account. That is salary. Chanda was paid salary of 1,200,000. What else? Share of profit. Chanda 1112. Pete 1668. Pete 1668. So that is how you do it. So what else should we record on the credit side? Candidates, always remember the credit side of the current account is used to record any amounts that the partnership business owes the partners. So for example, interest on capital, this is the amount that the partnership should pay the partners. Salaries should be paid to the partners. Share of profit should be distributed amongst the partners. Remember, we also had the interest on loan. There's a partner. There is a partner who advanced loan to the partnership, and there is interest outstanding. This is Pete. We calculated it here. Pete, the amount is 400. Pete should be paid interest 400. So candidates, these are the amounts that the partnership owes the partners. And always remember that the credit side of the current account is used to record the amounts that the partnership owes the partners. For example, the interest on capital, this interest has to be paid to the partners. The salary is to be paid to the partners. The profit is shared amongst the partners. This interest on loan was to be paid to Pete. He advanced loan to the partnership. But the debit side of the current account is always used to record the amount that the partners owe the partnership. For example, this balance that was brought down here from the trial balance, at the start there is a debit balance on Pete's account, Pete's current account of 1 million. This balance, this means that Chanda, at the start of the accounting period, Chanda owed the partnership 1 million. So on this side, we record any amounts that the partners owe the partnership, and one example is the drawings. Drawings, these are amounts that the partners owe the partnership. Drawings, Pete 3.6 million. 3.6 million. Chanda 2.4 million. 2.4 million. Another item will be the interest on drawings. Interest on drawings. the partners or the partnership interest on drawings, and that we calculated here. Interest on drawings, Pete 360, Chanda 240. So these are the amounts that the partners or the partnership. Then we have interest on current account. This current account, there is an interest that that Chanda owes the partnership. So of 100, we have calculated it here, of 100. We have to deduct, but Chanda is yet to pay, so we will debit this account 100. And you need just get understanding, candidates. You don't need to memorize all this. Here, these are just accounts. This is the money that, for example, this Chanda's account. This is the money that Chanda expects the partnership to pay him. Then these amounts, these are the amounts that is taken out of the partnership. So we want to do the balancing so that we can see the position at the end of this accounting period. At the end of the accounting period, what is the position? What will be the position? Will we have debit balances or credit balances on this account? So we will add, let me start with Chanda, add 1 million plus 2.4 million plus 240 plus 100, 37, 40. 37, 40. I can see this side is greater than the other side. This is 37, 40. And let's deduct the 300, deduct the 1200, deduct 1112. So we have a debit balance again on this account of 1128. How about Pete? Pete, I can see that side is greater than this side. So let me add this side first, 2000 plus 600 plus 16,8 plus 400. So I'm getting here 4668. 4668. I'll deduct 3960 to get the balance carried down of 708. This is 4668. We close the accounts. Then I have 3740, close the accounts. So at the end of the accounting period, we can see that Chanda owes the partnership 11, that is 1,128,000, and the partnership owes Pete 708,000 shillings. That's the essence of preparing the current account, so that the partners can know how much they owe the partnership or how much they're supposed to take away from the partnership. Because remember, the purpose of running a partnership business is to make profit. So at the end of the accounting period, the partnership will credit the bank account with 708,000 shillings and pay Pete. On the other hand, at the end of the accounting period, Chanda will pay the partnership, and when the payment is made, the bank account will be debited with 1,128,000. That is if Chanda pays. If Chanda does not pay, then in the subsequent, in the next accounting period, we will have 1,128,000 appearing under current account balances in the balance sheet.
Hi candidates, welcome to another session of Manifested Online Classes. We are still continuing with the topic of group account, and in this session,